I have some great news. Inflation should be back around 2% in 2024. There's the ending. But like a good Tarantino movie, it doesn't make sense until we see how we got there. So in this video, I'm gonna show you how to predict inflation in 2024 or any other year in the future. Now, of course, we're doing this because inflation is a key driver of interest rates, stock prices, and bond prices. So if you wanna manage your own investments, this video could help you make smarter decisions for the rest of your life. After I show you how to predict inflation, I'll also show you how to turn that into valuable market insights to inform your future investment decisions. Like I covered in my last video on inflation, these are the main components of CPI, the Consumer Price Index. Since housing is almost 50% of inflation, any good inflation prediction should start there. The biggest component of housing inflation is called owner's equivalent rent. Essentially, it's a survey where they go around asking homeowners how much they think they could rent their houses out for. But people don't see the price changes on their house every day like they do with a stock. So it tends to operate with a lag of about 9 months to a year. We'll come back to this in a second. The other major component of housing is just called rent, which measures how much actual renters are paying for their apartments and houses. This data also tends to operate with a lag, but more like 6 months. So the inflation rates for rent and owner's equivalent rent have already fallen from around 9% in the last 3 months of 2022 to below 6% in the most recent 3 months. But that's still showing backward-looking data. So where might these figures be headed for next year? For that, we can look at more real-time data from Zillow. The Zillow Observed Rent Index, or ZORI, tends to predict where CPI rent is going, at least directionally, about 6 months in advance. So if we add ZORI to that chart, but move it forward 6 months, we can get an idea of where CPI rent might be heading. In the last 3 months, have seen rents increase at an annual rate of only 0.5%. That means that around mid-2024, CPI rent should be reflecting that. It's been a similar story for home prices, which are more predictive of owner's equivalent rent. In 2022, they rose a lot. But over the past year, they've been basically flat. By mid to late 2024, when the lagging rent and owner's equivalent rent figures start to reflect the reality that I just showed you, that's over 40% of core CPI that is currently reflecting more than 7% inflation and could fall to more like 1 or 2%. That alone would lower core CPI by more than 2%. And where's core CPI right now? About 4.1%. Now, there's probably not enough time to predict every single item in CPI individually, nor are all of them as easy or important, but I'll sum it up this way. In mid-2022, only 13% of the CPI basket was rising at an inflation rate of less than 2%. By contrast, almost 2/3 of the items they measure were rising at over 6%. Now, about half of the CPI basket is rising at a rate of below 2%. And 1/5 of the items are rising at over 6%. The drop in inflation has been big. It's been broad and it's likely to continue. Before we get into market implications, there's one more really important thing to watch when you're predicting inflation: the labor market. Wages aren't one of the components of inflation, but they impact many of the components of inflation. The more money people make, the more they have to spend on stuff. And the more companies have to pay people, the more they have to charge for their goods and services. So it can work both ways. You can see that wage growth is still pretty high, but it has been falling. The same can be said for the number of job openings. Still high, but falling. When there are lots of open jobs, it means companies are having a harder time finding workers. When they can't find workers, they have to pay more. That leads to rising wages, which leads to rising inflation. So if the downward trend we've seen in job openings continues, that should also lead to lower wage growth, and thus lower inflation. Another major factor that will impact wages and the unemployment rate will be if we have a recession next year. If we have a recession, or even just an economic slowdown, which I still think is pretty likely, that would generally raise the unemployment rate and lower wage growth. Consumer spending would fall, and inflation could fall by even more than I'm projecting. To sum it up, I think there's a strong case to be made that inflation will fall back to around 2% in 2024 with or without a recession. So let's think through how that will impact the market. The Fed considers their neutral Fed funds rate to be about 0.5% above inflation. The neutral rate is the level of interest rates they would target to keep the economy steady. Right now, they're aiming higher than that to bring inflation down to their 2% target. If we were in a recession, they'd aim lower than that to boost the economy. If I'm right, and inflation falls to 2% next year, that means the Fed would theoretically cut rates by more than 2.5% from where they are now. They're not robots though, so if we don't have a recession, I'm skeptical that they would actually want to cut that aggressively. That said, I think they would likely cut rates by a lot, and we could get to a 2.5% Fed funds rate in 2025. This will be great for the stock market and the bond market. I think growth stocks would do especially well in this environment. If there is a recession and inflation falls below their 2% target, that would be even better for bonds, but probably not that good for stocks. What this means is that while the market is always uncertain, it's very likely that inflation will keep falling and interest rates will follow. That means bonds, at least short-term bonds, are likely to provide a positive return and maybe even do better than normal, earning close to 10% in a recession scenario. All else equal, falling inflation and interest rates are good for stocks. But in my opinion, the valuations as of early November, when I'm filming this, already reflect this rosy scenario of falling inflation, falling interest rates, and no recession. Thus, I'm so cautious on stocks right now, and I would not at all be surprised if there were a 10% correction in the stock market at some point in the next year. I'll be sure to put out a 2024 market outlook before the end of the year, but those are some initial insights that you can gain from predicting inflation. And last thing, if you want to join my free Discord, check out the link below in the description. Thanks for watching.